The economic crisis is about to worsen. Hey, everybody, you're watching Bull Boom Bear Bust, back with another dose, BX4 News. Ride the bull, prepare for the barrel. Let's go ahead and get into it here. Folks, we've got a lot to get into. Tariffs. Tariffs are scaring some retailers. In fact, we see retailers out there already warning about higher prices to come. And I think that's going to actually be very, very soon, because we saw what happened a few years ago when inflation took hold. Retailers used the excuse of supply chain disruptions and other excuses to raise prices, and now they're going to use the tariffs to do the same. We're going to tell you the details, going to get into that, and some other economic warnings out here. Let's start right here, though. Auto parts chain closing 700 stores, 7 in New York. So we've got used cars prices still elevated, still not where they were back in 2020. And you would think that more people would need to go to these auto parts stores because they're driving older cars. Remember, older cars are staying on the road longer because the prices of new cars are so out of reach for so many people. So more people are going to use cars. So you would think that auto chain stores would be doing fairly well and have a lot of demand. But in this case, we've got 700 stores closing. A retail chain known for selling car parts closing 700 stores. Advance Auto Parts, we've got one of them right down the street from my house here, plans to close approximately 500 stores, including 200 more independent locations, 4 distribution centers by 2025 as part of a restructuring plan. Advance Auto Parts saw a $2 billion sales number during the fourth quarter 2024, but suffered an operating loss of $820 million. The retailer, known for selling car batteries, motor oil headlights, and auto-related products, said it's seen waning sales since the beginning of 2024. So with more people keeping their cars longer, in other words, the average age of a used vehicle on the road right now is very high compared to historic norms. Again, you would think that these retailers, auto parts stores, would be doing pretty well. So are people putting off repairs? Are they not upgrading to newer headlights like when they normally would? Are they putting off getting oil changes? That's the question here to answer, is to see why this retailer is closing down so many stores. All right, but other news to get into today, folks. We've got retailers out there warning on the tariffs, including Target. The tariffs could raise producer prices in the next few days. Target CEO says expect price increases in the next couple of days because of tariffs. So the timing on this is interesting. With all the inventory they already have in their warehouses, why would it be so sudden when the tariffs haven't even taken effect yet? I mean, technically they're in effect, but the shipments that started when the tariffs took effect haven't even gotten to the shores yet, right? When you're talking about different imports with the U.S. And later we're going to talk about the impact of tariffs. Will it be positive? Will it be negative? Well, we know that prices are likely to rise, and that could be temporary, but there could be a long-term better outcome than some may expect. We're going to get into that here later in this report here in just a few minutes. But first of all, remember back in 2020 and beyond, 22, 23, 24, how the profit margins got larger for a lot of these companies. We saw used car dealers, for example. They were making more money, new and used, because of the excuse of supply chain disruptions, labor shortages. Remember that with the whole sickness, the fear, and everything else. And they used that as an excuse to raise prices. Yes, prices would have increased anyway because of the supply chain issues, but it was made much worse with the greed that was implemented after the crisis. And they used that as an excuse to raise prices, and nobody thought twice about it because they said, yeah, we've been hearing on the news about supply chain issues, labor shortages, everything else that went along with the health crisis. But yet we saw those massive explosions, basically surges in profits from everything from the major big retailers down to the small individual used car dealer who were basically used that as an excuse to keep prices high. So could that be what retailers are going to start to do? When you see these warnings come out here from Target and others saying it's going to happen here in the next few days, you have to wonder, are they raising their prices on stuff they've already accumulated or things that are already in their warehouse? It looks to me like that's the case. I mean, please let me know what you think about this down in comments. I'd like to read your thoughts on that. If you agree, if you disagree. I think there'll be a big surge in prices because there's this greed, and now there's an excuse out there to be more greedy. So as we've seen in the past, companies, when they make more money, when they get tax cuts, they don't tend to pass along the savings to the consumer. It's just more money that gets held at the top, or more money that gets funneled to the top end of the company. And that's what I've seen in the past. And maybe you disagree. Please let me know down in the comments what you think about that. All right, Bloomberg's out with this one. Wall Street banks say markets are flashing rising recession risk. Now, on one hand, you think that, okay, rising prices, it's going to be the straw that breaks the camel's back because consumers are so loaded up on debt. Delinquencies are already rising. Credit card delinquencies are up there, actually past where we were pre-pandemic. And let's go ahead and bring up a chart on this right here. We'll start off here with a 10-year chart. And we see going into the health crisis 2020, you see in the shaded gray area there, we had charge-off rates on credit cards were right at about 3.6%. But if you look here, recently we saw this big rise after the drop. The big rise now we're up over 4.6%. And the thought on this is, with delinquencies and defaults and charge-offs already rising, the current levels of debt that most consumers are under right now, add on higher prices on top of that, so another surge in the CPI number possibly. The theory is that consumers will not be able to withstand this, and that you're going to start seeing a big surge in these delinquency rates, these charge-off rates, and that's going to be negative for the stock market. Now, my argument has always been that the stock market's propped up by the top 10%. The top 10% own about roughly 90% of all stocks. So if the top 10% choose to not sell their stocks, then you won't see a drop. But if you see a concerted effort between the top 10%, the mega institutions, the multi-billion corporations, multi-billionaires, you're going to see then the stock market drop. It's controlled in that manner where it's not a majority of the population that controls it. So in other words, even if 90% of the people are in poverty and pull back on spending, it won't matter if the top 10% choose to not sell their positions. Now, if the top 10% see a threat to their profits because their customers, which is the other 90%, won't have money to spend, that could cause some uncertainty and some concern and cause them to hit the sell button. And that's when you see the stock market come down. So it's going to be interesting to see how it plays out, folks. All right, next, let's talk about these jobs numbers, folks. 77,000 jobs added in February, far below expectations. And these are private companies. 77,000 new workers for the month, well off the upwardly revised 186,000 in January, and below the 148,000 estimate. That's how CNBC put it. Folks, we're going to see jobs plunge if what we see that's began to happen continues. And we're talking about, of course, the federal cuts, and we're talking about rising prices, because once consumers get priced out, unless the banks can really step up and extend more credit, then you're going to see a big pullback on spending, and people are really going to be struggling even worse than they are now. And already, right now, 70% of people, if you ask them, they would tell you that we're in a recession. And then that's how many people are living paycheck to paycheck right now, even before these tariffs take effect and make prices go higher. All right, now still on the topic of tariffs, could there be a silver lining, or could there be the grass is greener on the other side scenario for tariffs? We'll take a look at how dependent Canada and Mexico both, how dependent they are on the U.S. Brought this up here for you. In 2023, Canada's exports to the United States were about 19% of the country's total GDP, and that was based on exports of $410 billion. So if they try to retaliate, or if they try to fight back, or do something to try to get even with this, so to speak, it's going to be a big hit to their economy. And Mexico also is seeing something similar. In Mexico, 2023 exported $456 billion to the United States, which is 30% of Mexico's GDP. right? So you see these countries really are heavily reliant on the US dollar and US consumers, where US consumers are still the world's largest economy. All right. We're not the world's largest country, but we're the world's largest economy because we have the availability of all this credit and money to spend and the world reserve currency. So dollars are still predominant throughout the world, still making up over 60% of all world trade, still denominated in US dollars. So when you have that type of leverage, you can really kind of throw your weight around, so to speak. And I think that's kind of the strategy where they're coming from with the tariffs. These other countries are still reliant on the US dollar, right? Even though we've been hearing about de-dollarization, there hasn't been much of an effect when it comes to the dollar compared to other currencies around the world because they're all fiat currencies, right? So that's the thing there. But look at the cost of living and look how much your dollar buys you. So in one sense, the dollar continues to crash and plummet because it doesn't buy as much as prices continue to rise. But on the other hand, compared to other fiat currencies, it's holding its own. It's holding its weight. It's remaining pretty strong. And that's why these tariffs could actually end up working in a positive way and brings jobs back to the U.S. But then again, we have to look at how many companies will want to bring jobs back to the U.S. when the cost of living is so high. So we need a combination of a drop in the cost of living, in other words, deflation, which is going to be looked at as a recession and also could cause panic in the stock market and amongst retailers and more. So it's going to be very interesting to see how this all plays out. But tariffs are not necessarily going to tank everything long term. It could be painful at the beginning and ultimately end up getting better. All right, now on that topic, we have Mexico out there planning retaliatory tariffs. Now we'll see if this plan that they have, this action that they have, stays, because we've seen threats from some other countries and they ended up backing out of it. The U.S. has long exerted an almost gravitational pull on its neighbors. Canada's automobile industry is hardwired to that of the U.S., and people back and forth across the border, shop, visit, or commute to work. But here's what happened just recently. There's been a pause for 30 days on automobile-related tariffs. All right? Tariffs are delayed on cars from Mexico and Canada by 1 month. So obviously there's some fear out there that these tariffs are going to be highly inflationary. So are they trying to bring back more manufacturing before the tariffs are implemented? Well, 30 days is not very long. So that's not enough time, not nearly enough time for an entire automobile manufacturer to come back and set up shop and start producing cars. And just the talk of this delay, or the news of this delay, actually was one of the things that kept the stock market mostly positive on Wednesday, March 5th. So we can see that tariffs are going to go hand in hand with how the stock market performs, and we'll see how it all plays out. But with consumers in so much debt right now, like we talked about earlier, delinquencies rising, it's going to be very interesting. And I would have to imagine that someone's going to be in the background telling banks they have to continue to give out more credit card lines of credit, increase lines of credit, to keep this whole thing flowing. Otherwise, if credit card companies start pulling back on these lines of credit, the U.S. consumer is done, right? A lot of people, I would dare to say even most people, rely on their credit card just to get by, just to put gas in the tank, just to put food on the table, just to pay the electricity and utilities. Now, something that's very interesting, I was just at the store earlier. The cheapest eggs I could find were like $7.99. But the Telegraph's reporting this: eggs are so expensive, Americans are smuggling them in from Mexico. Prices have skyrocketed following the worst outbreak of bird flu in a decade. And they're culling like millions and millions of chickens here. So people have now started smuggling them from Mexico. And it's noted here that the CBP has recorded a 158% rise in egg smuggling interceptions at its San Diego field office. At the El Paso station, they identified more than 90 people attempting to import raw eggs from Mexico between January and February, and that's also another big increase. And that should go back to what we talked about at the beginning, our dependence on other countries for imports. We're going to see how it plays out, but it looks like eggs are going to be a big thing that we're going to need to import, and you add a tariff on top of eggs that are already expensive here, and that could cause the problem to either get worse or not improve very much at all. And of course, things could change. The administration could say, well, there's tariffs, but not on food because that's considered more of an essential item. There's a lot of things they could do to try to skate around this or make things not as bad, but nobody knows exactly how it's going to play out yet. In February, thieves stole 100,000 organic eggs from a business in Pennsylvania, valued at $40,000, a crime that police suggested was triggered by rising costs. Of course, when something's worth more, when it costs more, it's going to be a bigger target to thieves. All right, next, on top of these cuts, these federal job cuts, there's a plan now to expand these layoffs out of the IRS and also in the VA, Veterans Affairs. About half of the IRS workforce is going to end up being fired. They're going to be firing up to 83,000 workers, folks. That's including the VA as well. So it's going to get very interesting to see that void in the economy and how they're going to fill that, because these people are going to have a drop-off in spending when you see these types of job losses. And we know that consumer spending is about close to 70% of all the GDP or gross domestic product. Folks, this entire economy is basically propped up on spending and the availability to borrow money. And when you add in a bunch of job losses and now tariffs, what's going to be the outcome of this? All right, and still on the topic of tariffs here for just a minute here. Let's see if we can zoom in here. Top U.S. China goods affected by tariffs. Cell phones. That's the biggest one there. Computers and accessories, of course. Electric and industrial equipment, toys, games, and sporting goods. Appliances and furniture. Now here's the exports, because they're going to be retaliating against us here. We export mostly soybeans, meat, poultry, cotton, some other things, fish. But you can see how much more dependent we are on China, but now we're tariffing these items. So our dependency on China could come back to hurt us ultimately. All right, folks, let's get into a little bit of real estate news before we wrap this up today. Here's just some example of how out of reach homes are right now for most people. The median home buyer right now, well, at the end of 2024, was 56 years old. That's the median age of the average home buyer, 56, and that's went up drastically. It used to be the median was in the late 30s a few decades ago. Then it went into the 40s. Now we're up to the mid 50s, folks. First-time home buyers, people that are just buying a home for the first time, their median age is 38, right? And that used to be like in the low 20s, like 23, 24. People used to buy homes in the 70s and 80s a lot in their mid 20s. Right now it's very, very small percentage of people that can buy their homes in their 20s, and the median age actually overall is 56, not counting just the first-time home buyers. If you count just first-time home buyers, median age 38, but overall it is age 56. The NAR data points to persistent home affordability issues in the U.S. And actually, Investopedia gives us a chart here of the rise in the age here. The average age home buying is surging. Median age 56 as prices continue to rise. This goes all the way back to the early 80s. And if you can look at the screen right now, you'll see a dramatic rise in the average age of the typical home buyer. And when it comes to the housing market, some more numbers that I thought were interesting. The latest data out of the Fed says in order to purchase a median price home, which is about $400,000 right now, one would need an annual income of $124,000, and that's so far above the actual median income, which is just under $80,000. And remember, when you look at averages, the top income earners can really make the average go up. So when you look at these averages overall, how much is the average income if you don't count the top 10% of income earners, which now account for about 1/2 of all consumer spending, right? So we see this balance is very tilted, very unbalanced rather, to the top 10% that are propping up the economy with their spending. So we're going to see how it plays out, folks. Let me know what you think about all this down in the comments. The tariffs, the warning out of Target saying that prices are going to go up in the next few days. We're going to see how it plays out here this week then. By the end of the week, are we going to see rising prices? And are they going to be gouging. We've heard the terms gouging and corporate greed and greedflation. We've heard those terms over the past few years. Is it about ready to get a lot worse, even though the tariffs haven't really impacted what's actually on the shelves yet, right? We're going to see how it plays out, folks. What's it going to be? You let me know down in the comments, please. Glad to see you all here. Appreciate you supporting this channel. Thank you very much for being here. Keeping this channel alive. As always, big love. Keep stacking. Bye for now. Peace.